So let's talk about banks. The U.S. economy is still technically not in a recession. It has 123 months of an economic expansion, the longest in U.S. history without an official recession. So banks should be good, right? They should be making record profits. There should not be any problems. They should have a good loan book. Wrong. Beneath the surface, there is an enormous amount of red flags. So many red flags that in the last couple weeks, I even saw the talking heads on CNBC Fast Money, and I respect those guys on there. They're smart, but normally they don't talk about these big picture issues. I even saw Guy Adami and others on there talking with Steve Eastman, who was one of the hedge fund guys who was featured in The Big Short, the book and the movie. I think it was Steve Carell's character. And they were discussing openly Deutsche Bank's derivatives book and how successful Steve Eastman was at shorting Deutsche Bank and why he was still short Deutsche Bank and the reasons he was short Deutsche Bank. And Guy Adami was even talking about the derivatives book of Deutsche Bank, the amount. So, the banks, there's a lot of problems with the banks beneath the surface, despite the earnings reports, the revenues that the banks are reporting. A lot of the banks, especially the American banks and some of the European banks. There's problems with Japanese banks. I'll talk about that in a little bit. I found a heck of a gem, a real gem. Thank you to David McIlvaney of McIlvaney Weekly Commentary, McIlvaney Financial. McIlvaney Weekly Commentary talked about this IMF report that came out, the Global Financial Stability Report. It's for free. Earlier in October of 2019. Well, I found this very interesting interview. And the interview from the IMF is talking about Chapter 5 of this report. Chapter 5 is the bank's dollar funding, a source of financial vulnerability. And this goes into a lot of the problems we have with the dollar rally that we've had. Yes, the dollar index is below the 98 support levels. It's down around 97, let's see here, around 97.47 when we're doing the show. But the trade-weighted dollar index is almost near all-time highs at 130.2977. That is a big worry for a lot of countries. That means the dollar is strong relative to over 26 plus currencies in the basket, mostly emerging markets. So on top of that, you have repo madness. If the banks were as strong as they claim with their earnings, there wouldn't be any need for repo madness. And recently in an interview, I believe it was yesterday, I tried to listen to the interview. There was audio problems with it. I couldn't hear it from even 5 feet away. So Jim Rickards did an interview talking about how he thinks, in his opinion, this repo madness stuff has to do with the fact that a large bank has already failed. So you have problems with European banks, the German banks like Deutsche Bank, more than just Deutsche Bank, the leverage ratios on the other banks like Commerzbank, they have counterparty risks, they have risks in derivatives. Spanish banks, Italian banks, the French banks have bad loans as well. They're connected to all those other European banks, and the European banks have bad loans into emerging markets. They have immense counterparty risk. Some of these European banks, maybe HSBC Bank and maybe Deutsche Bank, were involved in loans to China, into the Chinese banking system. The IMF report, if you want to read it, it talks about how the Chinese banking system is a mess with their credit bubble and their banking system. The Japanese banks are surprisingly having problems. And I found out from Martin North and my other Australian contacts that listen to this podcast, and I was shocked to learn this. I didn't know. I knew about the Australian housing bubble. I didn't know things were this crazy. But 4 of the largest Australian banks have tens of trillions of US dollars worth of derivatives now. Insane. So all these banks are just they've taken advantage of the system. They've abused. It's not just the U.S. banks. I know there's a lot of people who want to blame the U.S. for all the problems, but it's all the banks. Okay, all these large banks in all these countries are all doing really, really risky things, really, really dumb things. They're not thinking about the long term. These bankers are all trying to get rich quick, earn their bonuses, and they don't care if they blow up their own firm. They're basically suicide bankers, as Max Kaiser would say. So, I want to play, McKinsey came out with this report on Monday saying that if the global economy were to get worse, they said that 60% of banks may not survive an economic slowdown, which would mean that not only would we need repo madness, but then the Fed would have to drastically start increasing its balance sheet even more than it already has. And we just got the numbers on the Fed balance sheet, the official Fed balance sheet update, which I don't really believe, but I report on the official numbers, and then I also report on the currency swaps and others. And by the way, in this interview that I'm going to play, it's on the IMF's YouTube channel. It's going to blow some of your minds. But I found this after I took a look at the report from the IMF that David McAlvany talked about. I then found this interview on the IMF's website and on their YouTube channel. And for those of you financial professionals that make fun of me on Twitter and comment below in the YouTube, in the comment section of my YouTube saying there is no proof about the central bank currency swaps, you're about to eat an enormous crow pie, an enormous slice of humble pie. I'm going to play the video right now because, the audio right now. It's just this good. And we also have a Wall Street Journal reporter from the mainstream financial media. And there's lots of people in the mainstream financial media, and I've had conversations with them on Twitter for a long time. They were denying that these currency swaps, that Ron Paul got a one-time partial audit, government accountability audit in 2011, they were denying they never happened. So we have a lot of mainstream financial professionals, a lot of libertarian financial professionals denying that these central bank currency swaps happen. And I'm going to play this 8-minute interview right now, and you're going to see a Wall Street Journal reporter and someone inside the IMF openly discussing the central bank currency swaps. Here we go.
Thank you for joining us this morning. We're here at the International Monetary Fund, and we're going to discuss one of the analytical chapters in the Global Financial Stability Report. This chapter is titled Banks' Dollar Funding, a Source of Financial Vulnerability. I'm Josh Schumbrun. I'm an economics reporter with the Wall Street Journal, and I'm joined this morning by Adolfo Barajas, who's the lead author of the chapter. So Adolfo, to start off, why don't you tell us about why you decided to look into this as a source of vulnerability in the financial system?
Okay. The way we think about this is we have to go back to the global financial crisis. Now, we call it a global financial crisis, but we all know that it originated in a specific market in the U.S. So how is it that a U.S. mortgage market crisis became global? And one of the channels that we witnessed was banks outside the U.S., banks headquartered outside the U.S., had been growing their dollar activities, and in a very large scale, running up to the crisis. So they required U.S. dollar funding. And when the funding for these banks became impaired because of U.S. specific problems, there were reverberations. There were shock waves that spread beyond the United States and into banks and institutions that had no exposure to the U.S. mortgage market. So last year, April 2018, colleagues of ours in our department in the Global Financial Stability Report took stock of this issue and said, well, where are we roughly 10 years after the crisis?
And where are we now? I mean, what do we find? Does it look like we might be in for some sort of repeat?
So what they found, they indicated some vulnerability or fragility indicators, and they tracked these, and they said that the problem has not gone away. It isn't necessarily worse than it was during the crisis, but it certainly hasn't abated. So there are signs of concern that you need to track these issues. So we took their analysis and we went a little deeper, and we asked ourselves three main questions. Okay. The first question was, well, when we see these global non-U.S. banks, can we establish a link between the cost of funding and financial strains in their home country? So think of Japanese banks.
Right.
So Japanese banks do a lot of dollar business. They face a funding shock in U.S. dollars. Do we see reverberations of this in the Japanese banking system? And the answer to that question was yes, we do see that. So that was the most direct question. The second question was a little more indirect and not as obvious. We said, okay, given that same shock to funding costs, do we see strains in countries that borrow from Japan in dollars, say Thailand, for example?
Kind of, does it spread? Is there contagion?
Does it spread?
Yeah.
Is there a spillover? And we found that indeed. When there are these shocks, they spread to other countries that are twice removed from conditions in the U.S. So that was very, very surprising and very interesting to us as well. So the third question is, if we had stopped there, we would have said, well, there's a problem, what do we do about it? Mm-hmm. So the third question was, is there anything that can help? So the third question has to do with amplifiers and mitigators. So we said, given these shocks that have these negative effects, are there factors in the banking systems, for example, the Japanese banking system, that would amplify these effects or mitigate these effects? Mm-hmm. And some of these have to do with policy. So our main conclusion was, yes, we found factors that both amplified, and we found other factors that might mitigate these effects.
Now let me ask you, how surprising is it that banks rely pretty heavily on dollar funding? I mean, you look at the global economy, and the U.S. is almost a quarter of it. You look at the amount of trade in the global economy, and it's even a greater share of it's dollar denominated. So we know that the dollar kind of has this outsized use in global financial markets. Is it really a mismatch that banks use so much dollars in their funding?
That is correct. The importance of the dollar is if you look at it strictly, it's outsized in proportion to the size of the U.S. economy. And a lot has been written on this of the reasons behind the dollar dominance. And we don't go into that in detail, we just take that as a given. We say, given that there's this preference for dollars, and a lot of businesses around the world prefer to be funded in dollars, it's primarily non-U.S. banks that step in and provide this funding. And this is a perfectly effective means of spreading financial resources throughout the world. The problem comes in when these activities, these assets, tend to be longer term, they're loans, and they're being funded on the short term end. So it creates that
duration mismatch.
Exactly.
But one of the things we saw during the financial crisis was that the Federal Reserve was able to step in and provide swap lines. I mean, this is one of the things that may not have gotten the most attention during the financial crisis, but the Fed would make lines available to other central banks of hundreds of billions of dollars, basically taking care of that kind of short-term funding liquidity issue. Is it maybe pretty rational for banks to be in dollars because they have that Fed backstop, or are you a little worried about some moral hazard being created where banks think the Fed will be there for them, even non-U.S. banks think the Fed will be there for them, and so they're taking on too much dollar funding because of it?
Correct. Yes. So one of
Okay, I'll stop that for right there. This is with Adolfo Barajas, who's the lead author of this Chapter 5 from the IMF, and it's an economic journalist from the Wall Street Journal. Yes, they just mentioned central bank currency swaps. I could go and replay that section, or you can go back on the replay and listen to it. Even more confirmation. I already knew about it, but there's tons of naysayers that say that it's never happened, or it was only for a short period of time. Most people I've heard say that it never happened, that I made it up, and they send me some bullshit link claiming that the Fed has no swap lines open at all. So, the banks. Repo Madness not getting better. Repo Madness today was over. I was sent that hat tip to Wayne, who sent me some calculations. If you add in the term repos, over $200 billion in Repo Madness today alone. So it's not getting any better. The Fed balance sheet number came out. The updated Fed balance sheet number, the official balance sheet number, came out, and it's increased since the bottom at the end of August of over $208 billion. And remember, the Fed said, and I've been stressing this, the Fed said that their balance sheet would not increase at all because of Repo Madness. And then the amount of overnight repos has increased multiple times to now at least 120 billion. Started off, I think, like 20 or 30 billion overnight repos. Then it was at least 75 billion within a couple weeks. And then here we are over a month later since we found out publicly about Repo Madness, and now we're over at least 120 billion overnight. And the term repos, a lot of people aren't aware of those. Those are 14-day term repos. So, just more craziness from there. The interesting things also in that interview were, and I would encourage you, I'll put a link to it in the information and description section. It's only 8 minutes long. And the IMF report goes into detail, but they were talking about all these large Japanese banks are in the business of using dollar-denominated loans and playing games. So it's European banks, it's Japanese banks, it's not just the U.S. So I know a lot of people hate the U.S. and a lot of people hate the U.S. banks, but all these large banks are involved in these craziness. The large Japanese banks, boys and girls, are also involved in the collateralized loan obligations. They bought a lot of them. The Japanese banks, desperate for yield, have done a lot of crazy things lately too. The more I find out about this stuff, the crazier it is. There was warnings in the Bank of International Settlement report about Japanese banks and the Federal Reserve in September 2019, their global macro report, and also the Federal Reserve research report about collateralized loan obligations from July of 2019. So all these banks, large banks, are all doing dumb things. The most recent IMF report talks at length about dollar-denominated debt. You have emerging markets that have way too much dollar-denominated debt. There's 4 or 5 major global macro themes that are hurting emerging markets really bad. China slowing down, commodity prices, a lot of commodity prices are in a bear market. You have dollar-denominated debt problems in the dollar rally, and you have just total debt in general in emerging markets. And plus, the other killer is net capital outflows, which China is trying to stop. China has capital controls and is trying to get even more draconian with net to stop any net capital outflows. So let me talk about this McKinsey report. So they said 60% of banks may not survive an economic slowdown. A third of banks around the world are too weak to survive a severe economic recession, a management consulting from McKinsey said on a Monday report, pointing at a decelerating growth in volumes and revenues, with lending growth standing at 4% in 2018. McKinsey said the banking industry is in the late phase of an economic cycle. The 4% lending growth in 2018 was the lowest in 5 years and is also 150 basis points below the nominal GDP growth, a consulting firm said. While experienced professionals in the banking industry may have seen the cycle repeat itself a few times, this particular cycle seems different, the report said. Despite a small rise in interest rates, the global return on tangible equity, or ROTE, has stayed at 10.5%. So despite the banks getting cheaper and cheaper capital, they're not getting better returns. Why it matters, the stagnation appears to be coming from, well, except for people, credit cards maybe, but other businesses are not doing as well. The stagnation appears to be coming from emerging markets, where banks have seen their ROTE decline sharply from 20% in 2013 down to 14.1% in 2018, which McKinsey attributed to ongoing digital disruption. I would add the other factors I just mentioned a couple minutes ago about all the problems in emerging markets with dollar-denominated debt, bad loans, businesses that leveraged to the Chinese economy exporting there, with China drastically slowing down, even according to China's own data, and the commodities bear market in many commodities. All those things together, those 4 or 5 global macro headwinds, are not good news for emerging markets. So in developed markets, strong productivity and risk cost gains have helped banks improve their ROTE from 6.8% to 8.9%. Banks are also becoming more profitable because of interest on excess reserves, which gave them free capital and then free interest profits. And Danielle DiMartino Booth, I think, said that accounted for 20% of some of the large banks. The 4 largest banks in the U.S. that accounted for like 20% of their total net profits. So to improve the situation, McKinsey calls for banks to urgently consider a suite of radical organic or inorganic moves before the downturn. Struggling banks can make defensive moves, offensive moves, and tactical improvements to their businesses to improve the chances of weathering a slowdown. A defensive move can involve the improvement of risk management with advanced metrics and artificial intelligence. I'm just laughing at those suggestions. You can't improve China. Like China, for example, China is saying that they're going to deleverage. China cannot deleverage, and in fact, there's really no evidence that China's deleveraging. Kyle Bass has said that China's credit bubble's now way over $50 trillion US worth. So China is the official narrative that's coming in Western press, and that the either pro-Chinese government talking heads come on and say is that China's deleveraging and they're handling it. And meanwhile, then the amount of credit in the Chinese economy just explodes. So the banks can't handle it. What I would just say for those of you who are not familiar with Austrian school economics is go and read the basic Murray Rothbard books, like What Has Government Done to Our Money and some of the others. And I can't remember the exact name of the book because I've read a number of the beginner's books from Rothbard. But he talks about like the free banking era and the history of fractional reserve banking here in the US. And if you go back and understand the history of fractional reserve banking, you will understand exactly how unstable it is. And according to Rothbard, all banks who are doing fractional reserve banking are different degrees of insolvent. So if you're leveraged 20 to 1, you're more insolvent and more likely to go bankrupt than a bank that's only leveraged 10 to 1. So most people who say like this bank, that bank, banks, fractional reserve banks, and that's what all the banks are on, they cannot exist without central banks protecting them and governments and taxpayers protecting the central banks and the large banks. And the taxpayers are backstopping everything. So all the basic books from Rothbard, they just talk about this, like the free banking era. The free banking era in the United States was a good trial and error experiment. There was wildcat banking, there was problems, but you really saw the issues with fractional reserve banking. So depositors could get a higher return at a fractional reserve bank that was not backstopped by the Fed during the free banking era, but they were taking a lot more risk. And the banks advertised that you could get a higher return, but you could also lose all your money. So nowadays, the average financial professional, the average person on Main Street does not understand what fractional reserve banking means. They just assume that the Fed will have their backs. Go back and listen to what the Wall Street Journal journalist, economic journalist, said about currency swaps. He assumed that the currency swaps would always be there. And he said hundreds of billions. That was his number. The real number was much, much larger, orders of magnitude larger. So if you want to go in depth, if you want to study more about problems with the banks, the IMF report that came out earlier in October, it's pretty extensive. They go into details about how banks in different countries are getting involved in the hypothecation, rehypothecation, high-risk leveraged loan market, and then also in the euro dollar and other offshore dollar lending markets. And this is the problem when you have all this dollar-denominated loans outstanding, and all these people that borrowed were expecting a weaker dollar, and then the dollar is not getting weaker. The dollar is rallying. So beneath the surface, there are a lot of problems for banks. They don't really talk about it on the mainstream financial media. I was shocked to hear the CNBC Fast Money people talking about the amount of derivatives that Deutsche Bank has. Everyone on Wall Street knows this, knows how bad it is, but normally they don't like talking about it in public, especially on mainstream financial media TV and a show like CNBC Fast Money, where normally it's about very short-term trading and not about long-term global macro themes. According to McKinsey's report, and I have it open, they're saying that a very large percentage of banks, I think 60%, destroy capital, and only 40% of banks are actually run well. So what explains the difference between the 40% of banks that create value and the 60% that destroy it? There's stuff in the report I'm not going to agree with because McKinsey's very mainstream. I have friends who work there. They're not... I don't even know if they hire Republicans at this point. That's how mainstream they are. I think they political screen. I think they want globalists and Democrats. My friends that were not Democrats who worked there, I think they had to hide their political views, and they left after a while. Okay, quote, a decade on from the global financial crisis, signs that the banking industry has entered the late phase of the economic cycle are clear. Growth in volumes and top-line revenues is slowing. Loan growth of just 4% in 2018, the lowest in the last 5 years, and a good 150 basis point below nominal GDP growth. Yield curves are also flattening, and although valuations fluctuate, investor confidence in banks is weakening again. This guy also did an interview about the report for Bloomberg, quote, who works at McKinsey, a senior partner at McKinsey. Quote, we believe we're in the late economic cycle and banks need to make bold moves now because they're not in great shape. In the late cycle, nobody can afford to rest on their laurels. Yeah, and by bold moves, what they're doing is they're probably, we're not going to find this out unless there's independent financial audits at the independent audits at the Fed with transparency, full audits, that the banks are probably dumping in the repo back to the Fed, the repurchase agreements, they're probably dumping worse than the quote-unquote good collateral. And this is why we're going back with zero interest rate policy and potentially negative interest rate policy, and what Jim Bianco said, that ultimately he thinks there's going to be many, many hundreds of billions of dollars more in QE. Oh, thank you for the super chat, Mr. XYZ. My best guess, when will all this hit rock bottom? Just my opinion, probably after the 2020 election. Maybe 6 months or less after the 2020 election. Because it sounds like with the repo market, the overnight repos is increasing. It's increased a lot. The amount of overnight repos they're allowing and the term repos has increased a lot. And the not QE program, they're going to have to increase the not QE program soon. And I think the rate cut is already priced in for next week. I think it was like around 90% that the rate cut was already priced in. A 25 basis point rate cut. So you have the Bank of International Settlements, the IMF, the Federal Reserve, warning about leveraged loans and collateralized loan obligations. You have 2 out of the 3 warning about dollar-denominated debt. Okay, it's not just the U.S. banks. This is my main point. Australian banks, there's big problems. They have housing bubble, enormous housing bubble, and they have I was shocked to learn this, an enormous derivative book. Sounds like the Japanese banks are also involved in a lot of nefarious things too. The Japanese banks have been making a lot of dollar-denominated loans to a lot of other countries and foreign corporations. I was surprised to learn that South Korean corporations have enormous amounts of dollar-denominated loans, and the South Korean economy, their exports are contracting violently, and exports make up 50% of South Korea's GDP. So you have South Korean export firms that gambled on a weaker dollar, they borrowed in dollars, and now the dollar rally has really hurt them, and the South Korea's economy is not doing well. Oh, thank you for the other super chat. I appreciate it, Mr. XYZ. Pablo asked, when do I think we'll start seeing the dollar decline in the DXY basket? The problem, Pablo, is against the euro, and the European Central Bank is doing even more QE than the Fed is. European banks are even worse off right now than U.S. banks. For all we know, it could be a European bank with an American subsidiary that's been tapping the repo market. Okay, there's no way. The Fed does not want us knowing. The Fed intentionally does not want transparency. They do not want any of us knowing which bank or banks are the most aggressive in the overnight repo market and the term repos. Because if someone knew, the shorts would just go right after that company, attacking the stock, and the company could not have any funding, could have enormous amount of funding problems. The share price could collapse. The counterparties would start to get worried. That could freeze up even more things. It could turn into the problems that happened with the Chinese banking system earlier this year. So without transparent, independent audits and transparency, we don't know, and the Fed doesn't want this, we don't know which banks are the ones tapping the repo market. It could be Deutsche Bank. Jim, as I said at the beginning, if you missed this, because I know we have over 300 people watching now, Jim Rickards just did an interview in the last 24 hours, and the audio was bad on it, so hopefully they re-release it. I could not even hear the audio from 5 feet away from my laptop. But he said in this most recent interview, he said the reason the repo markets are not getting better and getting worse is he believes that a large bank has already failed, and they're intentionally not reporting it. Mark asks, are the derivatives causing the liquidity crisis for the banks? It might not be the derivatives, Mark. It could be dollar-denominated debt. The banks could just have bad dollar loans because the dollar has not gone down, because the dollar has rallied. It might not be derivatives. It might not be what I first of all, for the record, I don't agree with what Rob Kirby's saying, how he's blaming it on the oil market. I've had emails with Rob. I respect Rob. I just think he's wrong on this. I know the whole gold community is saying it's all because of shale and the oil derivatives. I disagree. The problem is these tens of trillions of dollars in dollar-denominated debt outstanding. There's over $10 trillion in dollar-denominated debt outstanding globally, according to the Bank of International Settlements, and a lot of it's going bad. George, I get messages from people in Australia. I have a lot of Australian listeners who say the exact opposite of what you just said. But the banks, if the banks are using repo, they don't have to report that to shareholders. It's short-term only. So if the banks report good earnings, they might be the ones tapping the repo market, and we wouldn't know. And the banks don't have to even report honest accounting anyway. They had mark-to-market accounting suspended by the FASB, Financial Accounting Standards Board, here in the U.S. in March of 2009. And a lot of people, including Dr. Mark Faber, and I agree with this, besides the U.S. doing TARP and the first QE program, the banks having mark-to-market accounting rules suspended, and they can mark-to-model. They could value assets on their book at whatever valuation they wanted. That's what helped cause the rally. Is repo madness also in Europe? No. Now, there may be, this is a good question, Ricardo, thank you for the question. There may be European banks with American subsidiaries like HSBC Bank and Deutsche Bank that have large presence here in the United States that have tapped the repo market. So no, the European Central Bank is not doing repo. However, let me add that the People's Bank of China in China, a lot of people are not aware of this. China has tens of billions in repo out too. So the People's Bank of China is also doing repo. It's been going increasing since January of 2019. That's a point my friend Brent Johnson of Santiago Capital makes, is that the U.S. isn't the only one doing stupid things. All these governments, all these central banks, all these banking systems are all one giant mess. Sonny asks, when I say bad, what does that mean? Bad loans means loans are starting to default and the banks might not be reporting it yet. So they haven't affected the bank's quarterly financial reporting yet, but a couple quarters from now, the banks might not be able to hide it. And that could be what's going on in repo, is the banks right now are reporting still pretty decent quarters, And a couple quarters from now, they might not be able to hide how bad things are getting. It just depends. This dollar rally has hurt the dollar-denominated debt very, very badly. I haven't been paying attention to Caterpillar stock, so I can't comment on that, sorry. Sometimes if a firm fires employees, the stock price goes up. Unfortunately, when human beings lose their jobs a lot, that means people interpret that as the company's cutting costs and the stock price could rise even if the earnings were bad. Middle guy looks like the Joker. Yes, he does. It's a good notice there. No, he's too skinny to be the Penguin. Maybe he was the young Chester Cobblepot. He was a young penguin. He was a pinguino. There's different types of bad. Are the banks like, is JP Morgan going to write off their Canadian credit card business? Okay, they took a write-off before anything got worse. Or is Australian housing bubble going to collapse and then the derivatives tied to the Australian housing bubble going to hurt the Australian banks? There's different degrees of this. Or are only some dollar-denominated debt outstanding, loans outstanding from European banks that they have going bad? Or Japanese banks? That IMF interview was interesting because they were talking, and it's in the report, about how much Japanese banks are issuing dollar-denominated loans. That's pretty shocking. I did not know Japanese banks were getting that heavily involved. So Japanese banks are starting to do some really dumb things again. And this goes back to central banks manipulating interest rates lower, financial repression, and Japanification, and zero interest rate policy and negative interest rate policy because they cause desperation for banks, pension funds, insurance companies, retirees, all looking for investment income. And this is why pension funds and U.S. insurance companies and Japanese banks are buying collateralized loan obligations because they're offering a higher yield. Now, eventually, these collateralized loan obligations, there's an enormous amount of junk in these toxic sausage, as I like to say, in these leveraged loans and collateralized loan obligations. These things are worse than junk bonds. And there will be, I don't know any timing on this, but this is just like when will the mortgage-backed securities prior to 2008, when will they blow up? Well, who knew the exact time frame? If you knew the exact time that they would blow up, you became a billionaire like Kyle Bass, or you made hundreds of millions of dollars like the people in The Big Short. If you screwed up the timing, you were a bum and probably got fired from your money management job. Oh, we have a record. Almost 400 people watching this live stream. Pretty good. So, if you want to read the warnings, the IMF report sounds very interesting. I read part of it. But there's interviews with authors of each chapter summarizing them. There's YouTube videos if you don't want to read them. And I already played one of them. I thought that interview was very good. No, I don't think the government wants Libra. The government wants a Fed coin. They don't want Libra. So, to summarize things, you have repo madness in China. It's smaller than the US, but it's still growing, starting in January 2019. You have repo madness not getting better here in the US. It's getting worse, in fact, from what I'm hearing. It's over $200 billion in repo taken today. Fed balance sheet's not going down as the Fed promised. The Fed told us the balance sheet with repo would not increase. And now we have a not QE program. There's way too much dollar-denominated debt. All these foreign banks, all these foreign corporations, all these foreign governments, all gambled that the U.S. would do QE, the U.S. would weaken the dollar rapidly, and then they'd be able to pay back their dollar-denominated debt in much cheaper, with a stronger local currency in much cheaper terms. The exact opposite has happened. The main problem I see right now is the dollar-denominated debt. That's one of the biggest problems in the entire system. And the gold community doesn't like to talk about that. The alternative media doesn't like to talk about that. It looks like China's going to go first. So we'll see. We'll see how things roll out in China. I think a lot more people are brainwashed in China, so it will be easier for China. We don't know. We don't know what pace. The balance sheet has increased in just the last 6 or 7 weeks. 7 weeks now by 208 billion. So I don't know if it's going to maintain this pace. I don't think it's fair to say if I know what the pace is going to be. The pace could increase. If you listen to what Jim Bianco said, he said this is not good enough. He said things are much worse. He said the repo is big warning flags. That something behind the scenes is going very, very wrong. We have warnings from multiple former Federal Reserve employees about the money market funds. And these money market funds, what they did, and the Bank of New York Mellon deserves blame for this, is the Bank of New York Mellon acted as a middleman, and they wanted to make a big profit. So they took money market funds, which are not supposed to be risked aggressively, and they started doing leveraged treasury bets with hedge funds. So the Bank of New York Mellon created a separate repo market for money market investors to provide their capital, and then hedge funds to lever up. And that market, since Bank of New York Mellon took over, I think, about 2.5, 3 years ago as custodian of that market from JP Morgan. And that market went from zero, almost zero, and it to 100 billion per month. There's a chart on the Bank of New York Mellon website bragging about how quickly they grew this repo market. It's a different repo market than what the Fed's doing. This one is for money markets and hedge funds. A crypto SDR, we're a while away from that. It's more likely that MMT is going to be implemented. I hate to say this. I hope I'm wrong. It's more likely MMT is going to be implemented first, especially if a Democrat wins the White House in 2020 or 2024. The U.S. doesn't need a cashless society immediately. The U.S. already has a lot of controls. The U.S. has weaponized the dollar and SWIFT. They don't have to do all these things yet. Kyle Bass has said that Chinese banks will probably be banned from SWIFT soon. Did you guys see what Kyle Bass just put out on his Twitter about Huawei? There's more sanctions, more charges against Huawei. That's probably not going to help U.S. and China trade negotiations unless the U.S. is trying to strong-arm China with more leverage. The Gematria Code asks, isn't MMT just Keynesian economics on steroids? Yes, in my opinion, it's very similar. It's based off a lot of mercantilism and Minsky. A lot of Minsky's financial stability hypothesis. that big government and central banks are required to maintain stability. And that governments, if they create inflation, they can just tax it away. Except that printing money and credit is creating inflation. So they're already creating inflation. And then the MMT people say that they can take away the inflation with an inflation tax. Diana says MMT is a means to tax you to death. Yes, 100% agreed. It is even worse, stagflate and tax and lie. Yep, negative interest rates are also a tax. The IMF also in the report, if you read it, the IMF suggests that every country has to increase taxes. Surprise, surprise. The IMF suggested that banks have to contract and that all governments should drastically increase taxes across the board. Oh, James says if you get out of line, they can lose your MMT FedCoin stipend. Yeah, you could get a social credit score doc. You can get an extra tax. They tax you an extra 15 or 20%. Or like me, they take my Google AdWords revenues down another 20 or 30%. They're already down 30% in the last month or so. And I've added less than 100 new subscribers in the last 6 or 7 weeks. Despite, I think, having some of the best content in the financial investing in economic space on YouTube. I've added basically 0 subscribers in the last 6 or 7 weeks. And brand new content every day. No, I don't think that the US will probably go... I don't think the US has to go to negative interest rate policy immediately. Yeah, that's why I'm trying to move people over to my Patreon, because if enough people chip in at $5 a month, it protects me in case YouTube zeroes me out. The problem with going to those other video upload websites, and there's a few of them, I have friends who have over 100,000 YouTube channel subscribers, and they tried going over there, is a lot of their listeners didn't follow them, and they lost 99% of their audience and 99% of their ad revenues. So they spent all this time trying to transition and then made no money and lost a lot of time. There's a lot of rich people in Silicon Valley who want China's social credit score system here. Let's just say that. I don't even know what TikTok is. Isn't that what makes like the short videos? Isn't that like one of those short little video websites? I'm not familiar with TikTok. I know what Vimeo is, and I know YouTube. And I know that Vimeo wants to charge me like $80 a month to do live streaming. I don't know why they want to charge me, but they want to charge me if I want to sign up there and do live streaming, they want to charge me $80 a month. Okay, we have almost 500 people at once listening to this live stream. Pretty good. So I will put a link to the IMF report. There's some interesting things in there. I don't like their solutions, and I'm using air quotes. Their solutions are all governments increase taxes, and the banks are going to shrink, and that's going to solve all the problems. But there's interesting, with these sometimes large banks or large government reports or like large globalist agencies, you get tidbits in there, really interesting stuff. The fact that there was the admission about the central bank currency swaps, I think is very big. Because I still run into people on a daily basis who say that that never happened. Like people that manage money, people that make 6 or 7 figures a year in the financial industry, they're like, you're making the currency swap stuff up, you don't know what you're talking about. So just, if you run into any of these people, just send them the IMF interview, where they admit it, they openly discuss it. And there's someone there from the mainstream financial media who they were denying that there was any of these currency swaps, because guess what? They didn't report on any of this stuff. Do you remember the mainstream financial media reporting on the currency swaps in 2008 and 9? I don't. There's very few articles that even talk about the Ron Paul one-time partial audit, the GAO, Government Accountability Audit that Ron Paul got in 2011. Ricardo, I disagree. It's only the Democrats who want the economy to crash. The Republicans don't. The Democrats realize that that would hurt Trump, and that would help them. That would prove that Trump was lying about quote-unquote greatest economy ever. In general, CNBC and Bloomberg spin a lot of things, because if you go back and watch the interview they did in the last month with the guy who did the research on the inverted yield curve, the finance professor, I think, from Duke University, and the Bloomberg people were giving him a hard time. Oh, we're not in a recession yet. Oh, you don't know what you're talking about. Oh, it could be 2 years from now. So the CNBC, Fox Business, and Bloomberg crowd spin everything to say the U.S. is not close to a recession yet and that the stock market is not crashing. Jim asks a good question. Jason, when the banks put up collateral in the repo market, are they actually swapping that collateral with other banks? No. They're posting the collateral to the Federal Reserve, and the Federal Reserve is then loaning them dollars. The banks are posting either U.S. Treasuries, agency debt, and now what is also considered quote-unquote good collateral is now also mortgage-backed securities. And in exchange, they get dollars from the Fed. And the banks are allowed to repurchase, which is what a repo is, repurchase these things the next day. So the loan is only overnight, technically, but without an audit, we don't know any of these things for sure. Without a real audit, real independent audit. So no, the banks are not doing that with each other. That's the interbank lending market. Repo market is through the Fed, which is why the Fed has talked about an even larger permanent repo facility. Okay, well, this is longer than I planned on going. I will put links to all these things I discuss in the information and description section. If you missed the 8-minute or so interview with the Wall Street Journal economics reporter and the guy at the IMF who wrote Chapter 5 of their new Global Financial Stability Report, Chapter 5 is about banks, dollar funding, a source of financial vulnerability. And they talked about how banks outside the U.S. are issuing a lot of dollar loans all over the globe, probably to counterparties that can't pay back the dollar loans, desperate for yield, desperate to make a profit, betting that the dollar will weaken so they can make money off a strengthening local currency, except that has not happened. And then they also talked about currency swaps. There was an admission of central bank currency swaps. Even though they said a smaller number, I'm taking it. I'm taking that they publicly admitted, again, that there were central bank currency swaps that by the way, the mainstream financial media refused to cover. So now this guy on the Wall Street Journal reporter is making it like everyone knew that in 2008 and 2009, the Federal Reserve was doing central bank currency swaps. But then why didn't this talking head at the Wall Street Journal and his bosses, his editors, his bosses report on it if, quote unquote, everyone knew? Okay, well, that's it for right now. I want to thank everyone for their time. And if you do make a one-time donation, it's available on my website. I also take crypto, but I'm not a crypto pumper like Bill Holter claims. And I'm going to focus on making the best, most unique content possible for everyone with information, analysis, and education.